Here are the 5 misconceptions of being a real estate investor. If you're hoping to get into real estate game, or if you're hoping to scale up your portfolio, you definitely need to watch until the end, because I'm going to cover 5 different important lessons that I learned throughout these 2 phases. So my name is Ping. I started investing in real estate since 2010, in student rentals, and all the way until multifamily and commercial real estate. And these are the 5 different things I didn't know about until I go through 2 different phases that I just mentioned. And number 1 is that cash flow in real estate really is not that strong. Even if you have $200, $300, $400, you can't really touch it. I have a few properties that's producing about $1,000 in cash flow. I don't normally touch the cash flow until the bank account surplus into a certain specific amount. In some smaller properties, it could be 15K, it could be 20K, but I definitely always want to have a bit of property reserve for the property. And part of the reason is if you consider using any of the cash flow from your rental properties, when there's a maintenance request from your tenants about roof leak, basement, HVAC, and all of that, it's going to put you in the red almost right away. So I highly recommend not to touch any of those profit until you started seeing a little bit more surplus in the bank account. And that being said, the risk involved in owning a rental property sometimes it could be pretty high depending on your personal situation. If you don't have a lot of stable income or a lot of capital to play with, my biggest concern is that you might invest in the property thinking that, okay, now there's a net cash flow coming in, you started using or relying on it, and all of a sudden you run out of funds to maintain that specific property, which end up causing a depreciation in your real estate asset. So that's number 1 that I highly recommend people not to rely on your net cash flow from your rental properties. That leads to number 2, which is later on I found out that a lot of real estate investors, they're not full-time investors. They simply can't afford being a full-time investors because, like I mentioned, you can't rely on the rental properties. The profit doesn't usually get realized until you sell or even do the refi, which, by the way, refinancing of your equity is just taking out a loan. You still can use it because it's a loan, so you want to use it wisely rather than paying off your lifestyles and all that stuff. So I started seeing a lot of real estate investors, they still end up having a full-time job or owning a business, and then they pour that capital into the real estate, which really got me a conclusion that real estate is a wealth preservation vehicle. Long term you will appreciate, but it's just not a business that can generate you the cash flow that you want. So if you're looking to retire using real estate as a vehicle, just know that the time frame might actually be much longer than you expected. Now on the flip side, if you can maintain your income through your full-time job, through your full-time business, and then try to allocate the funds in there, this can become a power play for the next 3 to 5 years for you, because the equity, all that stuff will continue to grow, and all of a sudden you're going to start seeing or have access to 100, 150K in your bank account without you realizing or do extra work. And number 3 is that your equity on paper doesn't really mean anything until you have the ability to refi or actually sell the building. I heard so many investor friends or in this network, everybody's talking about, hey, we just made $1 million or 500K in a market appreciation. Well, the things are really well, but the biggest issue is that the fact that you don't report enough income, for A or B lender residential properties, if you can't even get that capital out, it doesn't really mean you have the access to the funds. I always tell people that equity on paper, don't even pay too much attention to that. Long term you will make money, but it's not until you sell the property, realize the gain. This doesn't really mean anything. You need to focus a lot on the cash flow and leave that equity more like a bonus in the future. And another thing I want to mention is that people who talk about BRRRR method and only utilizing BRRRR method as their main primary strategy in real estate investing, don't look at how fast they're growing their portfolio. Their debt is extremely high because they keep doing the refi and then use that loan to buy another property, which means their cash flows are usually pretty limited. And if you look at all these people, I can guarantee you that they all run other sort of business to draw that active income in. So refinancing is a tool for you to expand, but it doesn't mean that you need to be constantly doing that, because you're getting more loan, because you gotta be very strategic with that loan payment. When the interest rate is low, you can totally grab that loan, use it as a 2, 3, 4%, and then leverage a business model that generates you over 10 to 15%. So it makes sense with that kind of spread. But in today's market, 2024, 2025, we're seeing a lot of 6, 7, 8% depending on what type of lenders that you're using. It's really challenging to create that gap. And in this case, ideally, I don't believe that BRRRR method is something that you should fully rely on. You gotta figure out a way to generate a bit of cash flow from your business or from your jobs, and try not to scale that real estate portfolio. And make sure you watch until the end, because these 5 points will really allow you to kind of understand exactly what to expect. But more importantly, I'm going to give you one strategy that we're currently using in 2025 to solve all of those problems. If you feel like you're getting some value out of this video so far, give me a like and subscribe, and let's get back to the video. Number 4, over leveraging isn't necessarily a good thing. So as a Canadian investor, we talk about the newer strategy right now is the CMHC MLI Select, leveraging up to 95% of financing. It all sounds great because you only requires 5% down payment to acquire an asset, but if you really truly think about it, I don't care if the amortization is 30, 40, 50 years. The fact that you have to leverage up to 95%, it just means that when the market shift it to different direction, you're going to be deep in the water. And that's the risk that nobody talks about. Guess what? The biggest challenge in Canadian real estate market is that tenants almost have all the right, more rights than the landlords. And my biggest concern is that if I have a fully leveraged building, like nicely done, putting a lot of work, finally get everything financing, the only benefits I can talk about is I didn't put a lot of money down. But there's many downsides as tenants not paying rent, negotiating the rent, tenancy turnover becomes an issue. If you got a couple tenants that are not respecting the building, they leave a lot of garbage chunks out there, all of a sudden waste management goes up, then your cash flow is going to be wiped out. And those are the stuff and challenges that not a lot of people talk about. And I'm finding very irritating way a lot of mortgage brokers, real estate professionals trying to push people to do a bigger stuff without fully assessing their financial situation. What I like to do, by the way, the moment that you started seeing a lot of creative strategy like this being implemented in the real estate market, it really means that the market is just not doing that well. So you have to find many different ways to be creative and try to build something so you can make the number work. And that kind of defeats the purpose of the real estate investing. I like the idea of not having to work for my investment. I want to allocate the funds where, things are a little bit easier, smooth selling, kind of like what we were seeing back in 2010 all the way to maybe 2018. The market was just so stable. It wasn't growing very aggressively. People are not trying to expand as fast as possible. And really, the real estate market was just a lot calmer. And if I look back, part of the reason why we're able to do so well in real estate was because honestly, price point was low. When we started seeing double, triple, quadruple in the real estate market, we didn't have that much balance in the mortgage, which really gave me a peace of mind owning those assets. Because if anything goes wrong, I know I have maybe like over 50% of the equity that I can sell out, cash out, and if I really need to do something, at least I can use that as a collateral to kind of keep expanding my portfolio. So CMHC MLI Select, as much as it sounds good, there's so many different downsides that you need to be aware. And I like to be riding the wave and not going against the wave and only make my investment work through 95% financing. It just doesn't sit right with me. And number 5, after dealing with a lot of real estate investor clients and then, people who are doing very, very well in this industry, the idea of passive income, throw that out of the window. This business is nothing but active. And I don't want to discourage you from, building your portfolios and all that stuff, because part of the reason why a lot of people want to get into real estate is the financial freedom, the control. But really, the control is what we're referring to. Let me give you an example. Having 5, 10 different rental properties, like actual cash flow, even though it's still an active business, even though you might be doing asset management or property management yourself for your own portfolio, at least the time to do certain things now is kind of on you. You get to plan your day, your schedule as you grow your portfolio. That's what's attractive to become a real estate investor. It's a different way to generate income, but don't confuse that with completely passive, laid back. You can do a lot of stuff outside of work, in the very beginning. Because again, first like 3 to 5 years until you have an infrastructure, a lot of moving parts figure out, a lot of people, the power team, like the local contractors, handyman, property managers, and all these people like figured out. You're going to be deep in the operation. This is a business that you need to operate, and it involves a lot of people. On top of that, you're going to see a lot of people putting out content out there. They're doing the renovation themselves to keep the cost low. They have some poor experience with contractors, not even mention the tenants. And there are more situations where you're dealing with a lot of things behind the scene, like for example, dealing with the renewal of your mortgage, finding a different lenders to keep the cost low. There's a lot of things that's behind the scene that you don't see. So treat this as an active business. Build it up to a certain point where you get to hire some VA, some staff. Once you can get to that level of a portfolio, then the business can afford you hiring other people to be involved in that operation. And then once you're out of operation, things will become a little bit passive. But that usually doesn't come for another 3 to 5 years. Now, I want to share a little bit about like what I would do in 2025 as a real estate investor. Whether or not I'm getting in or trying to scale the portfolio, the biggest issue is that if you can fully be aware of the first 5 things that I talked about, it really comes down to one simple thing. This market, Canadian market, worked extremely well in the past 5 to 10 years, but it's just not working the same way in today's market. So as we're expanding our portfolio, we're trying to shift it to a different market. Cross-border investing in the US market right now is one of our favorite strategy. We didn't have to worry too much about the landlord-tenant board, like Ontario, because they're over there's certain states that are just very, very landlord friendly. Tenants are in general respecting the landlords because there's no lease continuation, and you also get to have that security deposit from the tenants. And those are the stuff that I like about just having a different dynamic of the market condition between landlord and tenants. And on top of that, I really miss the idea of having lots of cash flow, not over leverage, kind of like getting back to what I was doing between 2010 all the way to 2018. The same model got me out of the engineering job like almost right off the gate, and I don't have to overpay a property at $800K all the way to $1.2 million. It's just a lot of work, a lot of stress, and honestly, at this point, you're kind of just gambling. So if you want to know exactly how we shift our focus into the US using the exact same model, kind of riding that wave instead of against the wave, and make that investment business a lot more profitable for ourselves, click the link here where we show you exactly how we pivot into the states and what are the things that you need to pay attention to.